what we're trying to do is create a centre of excellence within asset consultancy, specifically aimed at alternatives.
And quickly, Helene, just a shape of your client base, local, African, just a shape of the client base.
So if we look at the institutional side of the business, which serves pension funds and medical aids and that sort of thing, our business obviously is about 95% South African, because the reality is 95% of the capital in the continent lies in South Africa. There's small pools of capital in Botswana, Namibia, a bit in Kenya, and a bit in Ghana, and a bit in Nigeria, for which we do occasional work, but 95% of institutional work is in South Africa. In terms of work for GPs, in terms of valuation, actually the majority of my work is on the continent. So I'd say about 60 to 70% of the work that I do then is on the continent as opposed to in South Africa.
How's the business lounge at Lagos looking these days?
Not much better.
Sorry about that. Angeli, quick reminder.
I'm still Angeli, and I still work at Denton, so I'm didn't change over lunch. I'm head of private equity and investment funds for Africa. In terms of client base, I represent a lot of foreign investors looking to break into Africa, as well as local funds and PE houses that do deals locally, but also who are looking to expand overseas as well.
Good. Anne.
Sorry. Still Anne, but I should most probably check if I'm still with DEG after I said that PCVs don't work and I got quoted on Twitter, so I'm not sure if that represents the house view. So let's see what happens.
Welcome to our laboratory. We make things happen.
Okay. But other than that, still representing hopefully the German DFI as an LP in Africa, having engaged with more than 200 GPs over the last decade, and looking after an investment book on the DEG side with about 40 funds and 20 GPs across the continent. If you want the reminder about the investment size, much smaller than CDC, but we still like our $2.5 billion.
Excellent, very good. James.
Thanks, Graham. So James Bryce, CEO for EBS Advisory, the leading ESG advisory firm on the continent. We advise about 45 GPs, about 7 banks, and maybe 15, 20 corporates. We're in Ghana, Nigeria, Kenya, Joburg, Cape Town, and very proud of the fact that we have our directors in those respective countries are all locals. Talking to some of the previous points on previous panels. Basically, what we do is we help clients raise money and spend money responsibly, invest and optimize their carry based on using ESG strategically, as opposed to just the risk and compliance function. But further to that, I've also been working the last couple of years on how to develop market products on the ESG information and pricing mismatches that are present on the continent, largely due to a shortage of ESG data. So I've also launched the first environmental insurance product in partnership with Hollard across the continent, serving to de-risk investments and projects. We've also launched the first sustainability unit trust here in South Africa on the JSE, which proves categorically that ESG is a reliable, ESG and impact is a reliable indicator of future outperformance over the medium term. And we're in the process of launching our impact placement service. So helping projects and corporates and fund managers raise money from the increasingly important impact investor universe.
Great, thank you. Angeli, I'd like to pick up off the due diligence panel and the conversation that we began before lunch. And I was hoping that you could pull the thread through on where and how much do environment, social, and governance factors factor into the due diligence of the clients that you're working with, and where do things go pear-shaped?
I think for the impact investors, it's a huge part of what they're looking at, and I think the difficulty is probably in how you measure it, because it's not as simple as financial data where you've got measurements that you understand. And I think James will definitely talk to this, but the measuring impact factors and social benefits is very difficult. So now what we see is the ESG reporting requirements and the requirements that are put on portfolio companies are becoming more and more comprehensive, and DFIs have been instrumental and brilliant in actually ensuring that they are very robust. Companies also, or investors also, look for their own auditing rights. So, they would like to come in into the investee companies and check that they are actually doing what they're supposed to be doing on the ESG side. So, picking up on that due diligence point, we're seeing that, it's becoming more and more comprehensive and more and more properly audited.
Anna, you're an investor, but what is the shape of the DEG impact, and you can handle them separately, they're different things related, but cousins, if you will, ESG to impact? What does the DEG framework look like, and how different would it be maybe to some other DFIs?
I think on the last point, I don't think it's that different from each and every DFI. We all like to come up with our own questionnaires and question which each and every GP has to administer, although we essentially look at very similar aspects. And I think the IFC has certainly been leading on those parts with the IFC performance standards and has set a lot of standards, given their size, their outreach, their capacity, where we follow and slightly give it different turns. For example, DEG has launched our development effectiveness rating last year, where we look into the investee companies underlying the fund and obviously pushed an extra reporting layer onto our GPs to really look into how impactful is an investment. And impact can be defined and looked at from different angles, but for us it's always, it's growth, it's jobs and quality of jobs, it's creating tax revenue in markets, and essentially leaving a better business than we found when we invested, i.e. in size of management and reliability, in being a good corporate citizen. And that involves the part where James can add a lot more, obviously being a good environmental and social citizen as well. Follow good standards, be sustainable, make sure that it's not really going to leave harm to the environment around you, and also mitigate risks to it. We still see ESG as a risk mitigant in everything we do, because if you don't address a community on a resettlement or on an infrastructure development project, you may well face big commercial risks further down the line. And all those aspects for DEG stand on par with commercial returns we want to achieve, because that's where James also already touched on. For us, it's not the one or the other. We want to be commercially profitable, we want to achieve returns, but at the same time, the impact, and we can't do either or. So it always has to be both.
And you mentioned earlier KfW as your key funder and the important relationship you have as an investor. Have you had situations where that stakeholder, that investor, has pushed back on how you've described your choices to make investments and the frameworks you've chosen to use?
Absolutely. So KfW is our shareholder, and as you can see in our logo, everyone who's got my business cards or came to our offices, they clearly dominate. And they're a regulated bank. Right. So the amount of information they ask from us on a look-through basis is enormous. And Robert touched on it on the previous panel, but to say, has banks and Basel changed reporting and requirements? For us, definitely. The amount of information we asked from our GPs 10 years ago is way more than what we, was less, and now it's way more than what we do today.
Right.
And yeah, they challenge us on the way we look at it. They challenge us around the reputational risk, very much on parts. They challenge us. Germany's got a very strong no coal, fossil fuels policy. So our requirements to say, okay, what can we actually fund, what can't we fund, where's coal involved, are really strict, and they keep us on our toes. And the amount of inquiries our team in Cologne had to go through with Parliament this year to say, are we treating small-scale farmers the right way? Are we doing the right things? There's a huge amount of effort where we are being challenged and kept on our toes. And I think with keeping our homework proper and diligent, and also supporting our funds in doing it, although it sometimes feels more like we are cracking a whip to say do it, but I think overall it's going to help us to be open and transparent about and having a good conscience to say, no, we did it the right way.
And now that Deutsche Welle has their English language YouTube channel, I can follow that more easily. My German is poor, I apologize. I would like you to try and get a message back to head office about rolling out EVs for the ID brand for Volkswagen in South Africa. I think that would swamp anything else good you could do in the next 10 years, would be my view. James, sorry, you want to respond?
There's actually a project which we are working on with Volkswagen on that part, but you'll see it coming up most probably in the first quarter next year,
very
but
good.
not in South Africa, in a compact country.
Okay, very good. James, I heard from Anna reasons to grow your business, because Anna says compared to 10 years ago, we just keep asking more questions, or we have to report more questions back to our investor. I see a fantastic growth of business for you.
Thank you, Graham. I'm not sure what the question is. But maybe I could bring it back, just since I've got the mic, to investor relations, since that's the topic of the discussion. And we've seen, interestingly, in the last year or two, a remarkable surge in the request from our clients to do impact reports. Whereas previously, 3 years ago, 4 years ago, we were doing 2 or 3 a year. Now we're doing 17. So I think there's a definite surge in GPs wanting to communicate their values to their LP base, but also to future vendors, to their ecosystems. And one of the things I was hoping to talk about in this panel, so I'm just going to bring it back to that topic, was what can we learn from other sectors that have been reporting on this in an integrated fashion for much longer, and the best place to look to is really the JSE. The JSE was the first stock exchange in the world to require listed companies as a listing requirement to do what we call integrated annual reports, where they're meant to look at the symbiosis between financial and non-financial performance and creating what we call shared value. And private equity has largely raised its money. I mean, 80% of private equity funds under management come from the DFIs, where this is very close to their heart. So I think it's appropriate that there's this trend. I'm just concerned about some of the trends that we're seeing where it's not really commercially related. And I would encourage and put it out there that I think there's still a lot of opportunity to learn from the listed sector as to some of the pitfalls and the lessons learned in their since 2011. Their 8 years of compulsory integrated reporting experience, what's worked, what hasn't worked, what's a lowered cost of capital, what's broadened their funding base, but also speaking to their investors in a commercially relevant way. And I think that's where the growth opportunity is. Not so much in reporting on the basic risk compliant metrics, but how is this investment philosophy from this GP driving value for a sustainable, more competitive business, which when you exit, you get that value back. And I think there's a lot of exciting opportunity in that space.
Helene, you have one of the largest client bases investing in private equity. What are you seeing in terms of what do these institutional investors want to hear? What reporting do they want back from their GPs and the funds that they're managing?
Yeah, maybe just to start to say, yes, we have one of the biggest, investor bases into private equity and into alternatives. But, and that is quite important, but it's still a very small part of the universe. It's even at our largest clients, it's 5% at the most, right? Which means that when we talk about reporting, a private equity is a small part of a component of a bigger reporting world. And so for some the way in which PE has developed, with the DFIs being a large investor into it, has driven it to have certain reporting requirements are very well developed, like impact reporting. So, a lot of that information is already available because it's going to the DFIs. So if we started to look at impact reporting, which we do, we could easily get that information available for the unlisted portion of the portfolio. But that would still only then be 5% at the most of the whole portfolio. So there is very much a drive towards trying to look at ESG and trying to look at impact. But the question becomes, how do you look across a portfolio of bonds, listed equity, private equity, infrastructure, and you put all of that together, real estate, and you get measurable, comparable reporting, which makes sense across all of that. And it's not an easy task. And I think, there's the ESG side of it, but which is a risk management and a risk, identification sort of tool, which is very different really from the impact. Yes, they are related, but, in the way in which you look at it is totally different animals. And so, what's interesting is, firstly, yes, we are some of the biggest allocators, but even within that big allocation world, it still is a very small portion. And unfortunately, there is some issues around that. I think from our point of view, what is difficult is the fact that even though PE is that very small sliver, it's still always late, it's always incomplete, it's always, that's terrible, always a terrible word to use. But if you look at the way in which reporting comes in, when we look at when reporting needs to go out to the FSCA for pension funds, the most likely thing to still be outstanding and be late will be the private equity funds reporting. And I think if we can just get those basics right in terms of reporting is on time and timeous, and it covers all the basics that you'd expect, I think that already would help contribute to the way in which investors see it. I think from the impact and ESG side, I say, because the DFIs have always been invested, it's actually trying to spill it the other way. It's trying to say, well, we're already getting such good information from here. If we can take that and say to the listed managers, what can you give me which looks vaguely the same? Let's start talking about that. So that, that is definitely the way in which it's going forward.
Oh, and we were talking in the break about the demand side, right? And that's really how we began today's event, about where is these pension funds allocations? You're allowed 10%, no one's anywhere near there.
Yeah.
And you talking a bit about the pension fund or the institutional investor who you're working with, that they have to make decisions on how they're going to staff up or not staff up, how they're going to treat private equity.
Yeah.
Could you expand a bit on that?
Sure.
For the
So,
forum?
if we look at our universe, there's really three types of PE funds, right? There's really large PE funds which have their own permanent on-staff, large investment staff. Then you have guys which have maybe one or two guys on staff permanently, but mostly, it's done via consultants, or it's within an umbrella, or whatever the case may be. And then you've got the big, plethora of small funds. So the big guys, they, are in the position, and if you look at PE, the risk characteristics of it means that if you want it in a portfolio, you need to deploy over a time period in a measured, paced way. You need to deploy cash into private equity and into, let's say, at least 8 to 10 funds. That's all a very academic argument, but let's for the moment say over a 5-year period, 8 to 10 funds. That's sort of the minimum in order to get to the point where it doesn't add volatility and add more risk than you want it to for the return that it's supposed to bring. So in order to do that, you need a certain amount of staff, both doing the investments, and I think that a lot of people got burnt that way initially, as some people allocated cash and then became passive investors. They weren't really monitoring it, and they weren't serving on LPACs, and they weren't doing that, and then they found that came back to bite them a bit. So, guys are very much aware now that there needs to be a monitoring element to it as well. And if they look at all of this, they need a reasonable amount of staff, and staff with specific skills, which firstly is difficult to find. Those skills are difficult to find in this environment. But also, if you look at it, even at a 5% mark, if you look at some of these guys, about 10-15% of their staff are PE staff, or alternative staff suddenly, once they start getting a program going. And then they're going, but I'm only deploying 2% of my cash in here, but half of the investment staff is for this. I mean, I don't understand whether that's cost effective or... And it almost is a matter of, once you get to scale, if you're allocating 10% or 15%, then it starts making sense. But at that point, it takes a lot of monitoring in comparison to a listed program. And it also takes a lot more. In order to get diversification, you need to do a lot more allocation than what you do for a listed program. So it's just capital, it's human resource intensive. So those guys can do it, but some of them have issues around, how much time are they willing to spend on it. Then you get the mid-layer guys, which will never be in that market. So the answer for them really is a fund of fund, you would think. Right. Because, they don't have the permanent staff to select funds, to go through that process, to monitor. But then, yes, there are some fund of fund choices available, but they are pretty limited. And when you're looking at
limited how?
There is only a few of the guys around, and definitely only a few of the guys around with any sort of real track record.
Okay.
So there's not that many providers, and so yes, you can select, and we do allocate cash to fund providers because it is the right solution for a certain layer of client. But you'd love to see more choice and more competition in that particular layer. Out there. And then for the really small guys, the reality is at this point there is no option. And you were talking this morning about what is your pension fund doing, and for my sins, I am the chairperson of the pension fund in a firm full of people with opinions about pension funds. And we've looked at this and we said, well, why are we not invested in alternatives?
Fair question.
And it was.
Can I see the minutes, please? How did that conversation go?
But the point is, then we went to look at what is available at our level of allocation, and we have no permanent staff. We only have a check of about, let's say, 5 million to write. What are our choices? And the truth is, there's none. There is no choice for that.
I got
layer.
a chicken farm for you in KZN.
Can't
Great
wait.
deal.
That's
Great deal.
But there needs to be, they've been trying to get the pension fund industry to get less pension funds and bigger ones, and there's arguments for or against that, but there definitely needs to be some kind of aggregation vehicle in order to get those guys involved.
Excellent. Helene, I want to come back to your experience outside of South Africa as well in a bit. Anna, some of your thoughts on the whole investor relations, how can I put it, relationship? How is that for you, and when does it get a bit gritty, and when are things all blue skies, as you said earlier today? We're a bit overcast now, but we can imagine.
Yeah. I think the part where it gets tough is if you've got the feeling that information is withheld. And as we said over lunch...
What were the flags for that? Where do you start to sense that?
Look, I think over lunch we said one thing. I don't think as a GP you can ever really win on investor reporting, because either it's too much or it's too little. So it's a lot of work, and then you share a lot, and then investors claim, oh, I need a summary now because your reports got so extensive. If you are focused, then they complain, but we need more. So I think that's the trade-off, and you're never going to really crack through this. I think for me, when I was looking after our PE fund portfolio, the important part was always, I don't want to read a quarterly report. I want to know what's in the quarterly report because I've actually engaged with the management team up front. And my test was always, in Joburg, obviously, if the guy at the gate lets you in and because he recognizes you, then you've got a good relationship with your GP because you're there often enough and they don't ask you to sign in.
Nice. That could be a line item on the slide deck. I like that. Yeah.
But I think the important bit, and I think that was part of the Brage debacle, which was mentioned on the first panel today, is if you don't have the feeling that you can actually still trust what's going to happen, and it becomes being intransparent, if questions are not being answered, if you cannot pick up the phone and say, what's this call notice really being for? Where's the underlying investment? In the end, we are, and I said that we're entrusted with money to invest. We've got a mandate, and we need to check that the investment strategy we all agreed on in an LPA is also managed. So we want to know what happens, and we are, as much as the GP, exposed to risks which come out of the investments, financially, but also more so reputationally. Right. And that's where our interests lie, and I think through that, it's really the amount of being nervous if you've got a feeling someone is not really answering a phone call, being restricted to say, no, we've got it under control. That's my big red flag to say, if you've got it under control, then you shouldn't worry talking about it. So let me know what's really happening. And as the African PE industry is so heavily backed by DFIs, our institutions have all been around the block a while. CDC was probably longest, DEG since the 60s. We've got portfolio 200 indirect portfolio companies, 150 direct investments across the continent. We may have come across a challenge somewhere else. We may have dealt with somewhere, so don't hesitate to ask. But to have that level of relationship with a GP, I think that's where we always want to get to, and everything else is critical.
I'd like to pick up for Anjali and James. How about your quick response on the whole Brage debacle and the implications for the investor reporting relationship? A minute, 2 minutes, reflections.
I think reporting is at the heart of fund governance, and what goes wrong when you don't have proper reporting. There's so many cases now, so many scandals that you can look at, where that misconduct comes in, and it's all about transparency. It's good for obviously the investors. They're entrusting the GP, the fund manager, to look after their money. All they're asking for in return is to know how it's doing. And that goes to your point, having that engagement. It's not just getting the report, it's actually having proper engagement with your GP. From a GP's perspective, it's key because they've got fiduciary duties. Now, if they're being transparent in the way they operate and they're actually tapping into the know-how of their LPs, they're doing a better job. Even the advisory board members, they can't function effectively unless they've got the information that they need. So information, from my perspective, is key at every single level in the governance structure. As to your case, what can go wrong if it's not there? Well, at the one extreme, you've got the massive scandals, but there's a whole spectrum in between as well, where there's lack of confidence. There's the benefits you can glean from experience. So there's a lot of middle ground as well.
James, you want to add?
Yeah, thank you. I think it was ironic that Abraj was the first GP to bring out a sustainability index, and they marketed it very broadly. I'm sure many of you saw that, and they punted it very heavily. So it's kind of ironic that they didn't practice what they preach. But I wouldn't really blame them, because I think that there's been a lot of lip service and tick box exercises when it comes to particularly ESG, which, where I'm talking from. I just want to relate a story in this regard. We were asked to pitch on an impact report for a large on-balance sheet asset manager. And when we asked them, well, why do you want to tell your impact story? And to whom? For what purpose? Are you trying to raise money? You're trying to attract vendors? You're trying to prepare for exits? What's your strategic opportunity? And the response was, and a very seasoned team here I'm talking about, and the response was, no, well, we just think we've got a good story to tell. And I said, well, to whom? Again, why? What's your intention? You're going to throw money at this? Why? Surely you have some insight. And the response was quite interesting. He pulled out a competitor's impact report. And he said, well, we want one of those. So, I'm very worried about the amount of sort of strategic intent that goes into this disclosure. And I was really glad that Anna qualified, some of the parameters that's associated with impact and ESG reporting. She mentioned jobs, and then she very quickly said, and quality jobs. And if you look at what people report on from an impact ESG point of view, it's jobs, taxes paid, gender, maybe CO2 emissions avoided. We wouldn't call those impacts. We would call those outputs. You can employ 1 million sweepers, but they're still trapped in a poverty cycle that will take generations to escape from. I think what the LPs are looking for is, how is our capital being deployed to leave a positive legacy and a more competitive business in the long term? So what we are interested in seeing is the relationship between the human capital, social capital, and natural capital benefits, and the carry, and the justification of management fees, and the technical assistance facility money that's being deployed in this regard. That, to me, would give the LPs the comfort that their strategic objectives are being met. And that really does speak to the quality of reporting that they're receiving.
And just to pick up on that, it's not just a tick box exercise, which sometimes it does become. There's a real spirit involved in principle. You have to adhere to the principles. And we see a lot of that as you were saying, they pick up a prospectus that they've seen somewhere else, and it is a tick boxing exercise. So, that's definitely a pitfall.
So picking up on the reporting piece, so ILPA, the International LP Association, is that the right abbreviation? So they've released these reporting templates, Yeah, I mentioned earlier getting some model SLAs through Savka, and the lawyer nearly ran screaming off the balcony. But I see a value for this segment of the portfolio management space where we're trying to get more capital into private equity, so let's streamline it and clear out the pipes as much as possible. What is, if I can have comments from each of you, and please starting with Anna, what is your experience of the reporting templates? Are they... were you part of the team that helped develop them? Do you have a view, again, without threatening your career like you did earlier, but are they useful? Are people using them? And then Helene, if you can comment next, have you been able to adapt them into your reporting, performance and portfolio analytics, for example?
I think standardization is a great tool to get a good basis. And that's a yes and a no to your question. So I think it's always better to have a starting point and then to add and tweak, instead of starting nowhere. And there is so much learning already available for the industry from existing GPs, and to really share this knowledge and the experience. I think each and every DFI, and I know it's not easy to hit you on your own back, but we all have our own templates, and we always ask our same questions, and then we phrase things slightly different, but in the end, the core part is always very similar. But unfortunately, there have been tremendous efforts to harmonize. We've got it on a couple of standards. We're not there on the reporting side, but I think there's a huge achievement already from what have been done. And I think for the GPs, it's still the part, okay, how do you channel that? And I think we also want to leave roles to service providers in the industry and not just left them the whole time to really calibrate this, because in the end, you need an input and an output sheet, and you can market it there a lot, but yeah.
Thank you. Helene?
So, I mean, I started my career as a chartered accountant, which, you never lose your love for it. But the thing with accounting...
Sorry, did you say love for accounting?
You do.
Wow.
But
okay.
anyway, so in the 1890s, somebody defined the first accounting standard. And all it said is you must fairly represent the financial statements. That's it. That was all of it. IFRS now stands on 1,700 pages of how you should account. And then there's another 1,500 pages that tells you how to audit that. And I think impact is sort of, when we look at impact, we sort of go, oh, one day you'll grow up too as a standard. Because basically it's there. It's gone like we want to measure impact. That's where this started 20 years ago, right? And we still need to go through that whole exercise of getting to the point where there's a set of international impact reporting standards subscribed to by everyone. We know how we measure. And there's a set of standards that tell you how to test that, right? And I know that comes very glibly, and the reality is it's across a very wide range of things, and testing it is very difficult. But so, I mean, that really is the problem, is at this point we there is a will to show impact. The question is, what is impact? How do you measure it? How do you audit it? And there is a million answers, and some of them, I know there's a lot of good work being done in a lot of ways, and it can be done. But it is quite difficult because there is not uniformity, as I say. I will go to PE managers and they will produce things which come off ILPA templates, which come off the IFC's toolkit, which comes off the CDC, and the FMO's also got toolkits which are out. So that information is reasonably standard, but then what we forget is there is listed managers, there's cash managers, there is bonds managers, there's, and before we get to a universal measuring system and a way in which we can test that measurement, it's very difficult to try and get to that point. And we are at that point where we want to put in front of pension fund trustees and say, this is your impact. Trying to get there is a mountainous climb to do that.
And let's just set aside ESG and impact. Let's just say like ordinarily reporting.
Okay.
How smoothly is that going?
I mean, I think reasonably smoothly. I think this is an issue which is sort of linked to another issue, which is around when funds are initially structured, the fund documentation that's set up. And there's often, there will be, they'll try to set a standard in terms of what the reporting needs to look like, and it'll either refer to the ILPA reporting or there'll be some standard reporting at the back of it. I think it gets too little attention. And I think as pension funds become, institutional investors become a bigger part of it, the stuff that they're interested in is different. They're interested in trying to get risk exposure from the PE fund through their risk and exposure reporting so that they can rebalance portfolios off the back of that. So it's not exactly the same information. What I have a lot to do with is the valuation information, where the ILPA standard is very vague. It basically says you need to have enough information to be able to recalculate, which almost none of the reports have. It's just plainly too vague in order to bring somebody to account in terms of saying, well, this is not really ILPA compliant. So I think there is still a lot of work to be done, but I mean, there is a basic outline out there, but I think it's got to do with a lot of the issues around when funds are set up and the fund documentation is negotiated. There's a lot of devil in the details, which especially new LPs and guys, institutional investors who haven't done it before are not aware of and don't understand, and then they're stuck with it for the next 10 years.
And Angeli, when I hear there's misunderstanding or it should have been done better, obviously it's the lawyers who let us down on the contract and reporting side. Please explain yourself.
Well, we just like to put everything in and then leave it to everyone else to
Oh no, you're the
scramble with
1,000-page
afterwards.
contract person. We told you 6 pages, get in and out in 6 pages.
Exactly. I think, obviously, actually just like the templates, there's standard language that you can put into all these contracts, and I think it's actually up to the GPs to read and make sure that they can comply with what the standard language says in the LPAs. But I also think that, people should pore over those provisions before they sign it. They shouldn't just treat it as, that's one of the terms in your LPA. They should look at it. They should say, are we able to disclose material developments as they come up? Is that feasible? Can we, disclose litigation? What's the carve-outs we need? Confidentiality provisions. How much portfolio company information can we put out there? Sometimes that could actually harm the partnership because we're disclosing commercially sensitive points. What caveats do we want around that? And usually you do see caveats on that point. So actually, I think, yes, it's critical to put the right information or the right reporting obligations into the LPA, but I think it's also critical for everyone to sit there and understand and make sure that's what their expectation is going forward, rather than just using standard language.
And is this an area where side letters add complexity? Where's the space for side letters?
Some DFIs, for example, they have more stringent reporting requirements, and they'll often put that in a side letter. So yes, people do negotiate extra reporting obligations in side letters. But actually, if you get the information reporting right, it should be right for everyone, and you should be able to, give it to all of the LPs. I would still say focus on the main agreement and ensure you've got it correct there.
Anna, please. Did
Sorry,
you respond to the? Do you have a quick comment?
No, I'd like to follow on from Angeli and Helene as well. What you're speaking about, again, has been traversed by the listed equity market around proprietary disclosure and what's confidential and what's strategic. And you want to take investors into your confidence, but you also don't want to share all your crown jewels. Something that, another principle that I think private equity still has to grapple with, and that is one of balance in reporting. And the problem with the types of impact reports that we're seeing at the moment is they're largely marketing related. They're presenting private equity in a very squeaky clean image. And I think, post-Abrage, we do need to create a scope for a bit of introspection and where balance in reporting comes from. Personally, I believe that balance in reporting creates more credibility than trying to tell that you have all the answers for everything and that you never make any mistakes. Just by way of example, Anglo American in 2005 was the first mining company that admitted in an annual report that they had missed acquiring a nickel sulfide deposit in northern Canada because they chose to do extended consultation with an Inuit community. And while they were doing that, a competitor came in and snapped the resource from under their noses. Now, for a mining company, your balance sheet is predicated by the reserves that you have, the declared reserves. So this was a massive blow to their balance sheet. But in their annual report, Anglo American defended their view, saying, even with that knowledge, we would have still engaged with the Inuit community as a vulnerable community, because we believe that that was in line with our corporate principles. So apologies, dear shareholders, you've lost a couple of percentage on your headline earnings, but we still believe that this was valuable. So I haven't seen this in private equity. And in a post-Abrage environment, I do think it's relevant. How is private equity going to grapple with a world that is increasingly critical and scrutinizing around the caliber of management. The most mature integrated reporting organization, I believe, globally is a Danish pharmaceutical company called Novo Nordisk. And every year the CEO gets reprimanded at the AGM about why is he spending so much money on non-financial disclosure. And he responds by saying, you have to earn the right to make a mistake. And you know, Africa is a challenging environment. We heard the risk report earlier. I would envisage and I hope that the level of disclosure from private equity will mature along a similar trajectory over the next couple of years.
I think that could be particularly interesting. I know the head of ESG at Novo Nordisk has now said she will no longer complete ESG questionnaires, even from the major rating agencies. So it's quite an unusual approach and a very confident approach, you might say.
If I can just add to that, sorry, I agree with you entirely. The IFC performance standards have over 350 different reporting parameters, 80% of which are redundant depending on which sector you're in. A lot of money is spent on redundant reporting that is not material to the success of the investment. I would recommend that a GP far rather focuses on reporting a handful of parameters with quality data, time-use data, and correlated data than trying to complete a smorgasbord of data that isn't relevant. And maybe, perhaps, you know, since this is largely DFI-led, perhaps that's something that could be revisited. The IFC performance standards were last written in 2012 in DC, and I do think we need to look at a customized materiality framework for highly, you know, rapidly changing and evolving markets in Africa.
Thank you. Let's pivot back. Anna, if you could, respond to the comments that Anjali was making about how the contract could present what's necessary for the performance reporting, which is going to determine the robustness and the healthiness of that investor relationship. And do you use side letters, and when do you feel the need to use them?
We've got a side letter in each of our fund investments, and while the LPAs has grown to like 170, 200 pages, I feel the side letters have equally grown, and from originally 10 pages, they are now also at like 60, 70 pages, and I can see really laugh in the corner, wow. But in the end, I think the administrative burden we put on our GPs through that is you agree on something in the LPA, and then you override it in the side letter. And each and every one of us does it to a certain extent, and I think this is administratively extremely difficult, and we've got one of our GPs, they actually add 5 disclosure pages to each and every drawdown notice because they repeat the representation and warranties they give to each and every LP to everyone. They say, we want to be transparent, which I agree to, but I think it's also always the proof to say, look what you've actually done to us. You all insist on your own format, you all want the same, so we sign it 5 times and we give it to each of you. I think there is, on both sides, I don't think it's fair to only slap the GPs. And yes, you may quote me on that, but I'll also get a smack. I think it's also on the LP side where we can improve on those parts to actually say, if we agree on reporting, then have one report which works for all. And yes, there's regulatory requirements we all have to live in. We have to report given the Basel regulations, but there could or should ideally at one stage be a part. But James' point on information and sharing, the world evolves constantly. And requirements we had 3 years ago in our LPAs are not the ones we put on the new ones. And the amount of controls everyone is trying to maybe overburden now after a brush is also going to evaporate a little bit more. The only constant on those things is change, and it's always something which influences its typical behavior. And we are at the moment, I think, on the strong regulation point, and I think it's good that there's more scrutiny and more information, but it also needs to be manageable, because in the end, otherwise our GPs will look like banks and have 400 people in back office and 200 people actually doing the investments. And if you only administer yourself, you're also not going to win.
Yeah, I think we all agree on that.
Yeah, I think the goal is really effective reporting, you know, and we've gone from under-reporting now potentially to over-reporting, and we hope that, you know, we'll end up in the middle. But that is the differentiating factor, isn't it? It's got to be effective.
And the level of trust, sorry, to quickly add that, because Anjali, you mentioned that, and I think it's also about the LPs and especially us DFIs, how do we treat information.
Right.
DG holds a direct investment mandate as well. So are we asking GPs for parts and then invest in the same deal? The broader the market gets, the more difficult those situations as well get. And I think it's then prudent behavior from both sides to say, to which level do we trust? What are we asking for? Can we safeguard the information and act ethically? Because that's what it all comes down to in the end.
Helene, Anna just mentioned this element of trust, and it's fundamental to any institutional investor looking to make an allocation to asset class they're not familiar with. They'll turn to people like Riskira to kind of work them through. Can you talk a little bit about what you're seeing in other parts of Africa outside of South Africa around appetite for private equity, and if or how that investor relationship, that reporting relationship can help assuage some of those fears or build that trust, or is it just too mixed right now?
Yeah, so I mean, the thing about the remainder of Africa, the first thing we've got to understand is that the actual pools of capital available are really small in comparison. But there is appetite to start allocating that towards private equity, and there's a lot of movement and a lot of advocacy going on. The thing that is difficult in terms of most of the other markets is if you look at a market like Kenya or Nigeria, the capital market works differently than what it does here, or in the US or in the UK, which is sometimes difficult to understand, especially if you're an asset consultant, because we have a model and we build a model, you know. But a lot of the assumptions that go in the model don't really work that well there. And one of the things which is really difficult about those environments is the risk-free rate is extremely high. If you want to call it risk-free, the government bond rate is extremely high. So, you know, if you're in Kenya, you can earn 13, 14% on a government bond, and there's really very little or no reason for you to consider other investment options. So there's a large amount of education going on in terms of going, well, yes, that's true, but the assumption that a government bond is risk-free may be incorrect within this context. So there's definitely a lot more appetite and thought going into it, but there is this thing that there's a medium-term problem is if I accept even 10% returns from something else, you know, in dollar terms, you know, I'm still behind what I would have gotten from a government bond, which doesn't make any sense. You know, so there is an issue around that, but there is a growing understanding of the need to look at assets which are more inflationary resistant. And so there's definitely a growing need. There's both in you know, the leading markets for it really is Kenya and Nigeria, and in both markets the regulator has been very busy in trying to encourage people to start looking at it, but at the same time have been slow to create a regulatory framework which gives certainty. So, you know, on the one hand, they're going, yes, yes, you should be in, but on the other hand, they're not willing to say, well, okay, this is what a PE fund is, this is how it's regulated, this is why you can invest or you can't.
And the experience in Namibia and Botswana?
So in Namibia and Botswana, it's been a lot different, where there's been some appetite for PE investment because the regulators have given the go-ahead for that. But the thing is, it's really small markets. And that's also been the problem in some other African countries as well, is if the regulation says that you can only invest within your own borders, it creates an artificially very difficult situation if you've got 2.5 million people in a country. I mean, you know, to try and create a fund that, you know, can cover its overheads, do the investments, take on within that confines is really difficult. And from that point of view, the regulator maybe has some work to do. If, you know, it's a political issue, unfortunately, so it's not necessarily a strictly economic issue. But in both those countries, there have been PE programs where there's been some incubation done of PE managers. It's been a variable success where there's been difficulty in deploying cash, and because of that, there might have been some investments which were not entirely fit for purpose. So, you know, yeah, it's a mixed success, I'd say. Yeah.
Okay. I've noticed not many of you tweeting, so I know my panel is compelling enough to keep you interested. We need some questions from the floor. Do we have some questions from the floor? Questions. Otherwise, I'm going to, let me flip over quickly then to ask you to comment on the areas of capital calls and distribution notices, which is not something I'm hugely familiar with. But can you offer some insight into how that plays out in the investor relationship? Anna?
the call notice is obviously the first part to actually then deploy capital, because once we sign the LPA, we've committed to disperse, but the call notice is actually then the one to disclose, are we compliant with the investment strategy? What are we using the money for? When are we envisaging to use the money for? And to give us an amount of information, and obviously 3 pages of reps and warranties, what's going to happen with us. Distribution notices are usually more pleasant. Hopefully, in most of the cases, they usually come too late, like the reporting Helene said earlier. But it's obviously also around then how have we sold the business, are we making dividends, and that's where everyone, I think the information onerous on a distribution notice is less, because everyone is happy that cash is coming back. If it's below the originally invested amount, then we may ask a couple of more questions, but hopefully it's more. But I think the level of information which is being asked on the call to say not only if we've got an investment, where, when, with whom, how have we diligenced it? Did we do KYC sufficiently? Have we got all the information on Luxubit? That's where call notices and the information attached to it become separate agreements on its own, even though they are not countersigned.
Angeli, where do call notices, capital calls and distribution notices, where did they go wrong? When do you get called in?
Well, I think it's partly if they come completely out of the blue. I mean, this goes to the engagement factor that we've been talking about. You know, if there's a constant engagement and a constant understanding of what's happening in the fund, you should be expecting a call notice, and you should be understanding what it's going to be about. Without, you know, when you get it, great, you will see it all in there, but, you know, you should have that level of expectation beforehand. So I think it could go wrong when it just, you know, comes and takes you by surprise. And then, I guess, with the level of detail, you know, people want to know, investors want to know what their money's being used for. Again, ensuring that template that gets annexed to your LPA is in line with everyone's expectations is critical from the outset, so you don't have things going wrong during the course of the investment. And the same with the money coming back in. You know, people want to know where money's been lost. You know, why money, where's the leakage, for example. And ensuring that level of detail is in there is important. And I guess if there's any inconsistencies between the rest of the reporting, that can be problematic, because again, you know, they should all work together and they should be all consistently reporting on the same issues. So yeah, there's some of the things.
Helene, it would seem to me that it would be incredibly hard to report on private equity if you had a member investment choice defined contribution fund in South Africa. How would you even report that? You're not going to daily price, are you?
Yeah, I mean, that's one of the big issues. And I heard somebody saying this morning that, you know, in a way, valuation doesn't matter. It's a cash-to-cash business. But the problem is that for pension funds, it's not.
Right.
You know, pensioners are coming in and pensioners are going out. Right. And off the back of what you do your valuations at is what we pay those people and what they pay to get into the fund. So in essence, you didn't close once. Every quarter at quarter end, people are coming into your fund and people are leaving your fund on the value that you supply. So, you know, that's the first issue is in terms of we need it to be accurate. And that does not mean conservative. It means as accurately as possibly estimated. If you're, you know, people go to you but say, oh, it's okay because my valuation's conservative. Well, the guy who just left the fund, you know, is not happy about that.
Yeah.
So, I mean, that's the first thing. The second thing is, you know, the fund needs to trade. So it can't wait 3 months, 3.5 months, 4 months for reporting to come through. You know, it needs for its reporting to be timeous and allow money to flow between the pension funds. You know, there's a significant drag to cash that's not in the market. And if that reporting is late, it delays everything and it causes drag in investment returns, marked drag in investment returns. So, you know, it is one of the things with which we struggle because, the PE firms are not, it's like they don't really know where it's all flowing through in the end. So if my report's another week late, it doesn't really matter, you know, as long as my valuations are conservative, it's okay. You know, so there's definitely some education to be done from our side to say, listen, this is what we use it for, and it's important.
And I did notice in your bio, you mentioned 150 valuations.
Yeah.
And I'm all for data points and bios, but I'm super curious about these valuations.
Yes.
Across your experience, has anyone else had more than 150 valuations in the room? I'm assuming that's quite a large number. is in terms of doing that valuation and then thinking all the way back to, well, investors going to put this in front of the investment committee at some point, and then there's going to be the board that they got to pitch on, like, we're doing well, we're not doing well. Can you just talk about that little thread of work? Because that would seem like a real insight on the technicalities of this.
Well, I mean, I think the basics of valuation is very simple. It's the most probable cash flows discounted by the correct risk rate.
Mm-hmm.
And in the end, it's really trying to get to those two things, which flows all the way through. Is there needs to be a realistic expectation in terms of cash flow, and we need to take risk into account in a realistic way.
Mm-hmm.
And when we do those two things, then our valuations are at the point where it's the most probable at that moment, which in the end feeds through all the way to giving a member what they're worth. But also, when we do the valuations correctly, we correctly reflect risk, which is another issue, as people tend to forget that when you look at institutional investors, they're looking at risk from a portfolio-wide basis. And when you do valuations, but also when you report on your risk, it needs to be able to slot into that in order to allow them to do tactical asset allocation on top of normal, which is, sorry, I'm getting into the jargon, but basically to try and jig the portfolio to try and remove risk where it's building up, in essence. But for that, they need to understand exactly what they're looking at.
And just because I'm curious, if I had a company called WeWork, okay, and say I took retail property, real estate, and I had a co-working space, and I was looking to pitch that, do you have any reflections, maybe from recent observations of what's happened in the IPO market in the US, on what one would do better in that situation than what happened?
Well, I mean, the one thing I would say is what's interesting about that situation, which has been interesting in general in alternatives, is there's been a move towards, firstly, real estate and infrastructure. There's not really a huge difference between the two spaces, and they should be amalgamated. But the second is that real estate is no longer real estate. Real estate is real estate plus a service. So either you're looking at a security estate, which gives retail and commercial and all of those things together, and together that forms a package of service which gets delivered. And then it's very prevalent when you look at like WeWork. It's not about the building; it's about the building plus the service which is getting produced. But the problem, obviously, is to value that is significantly more difficult than real estate. Real estate is easy. I go look at what the building next door is valued at. That's what yours is worth.
Right.
But when we're starting to talk about a business which is in essence real estate plus service, it becomes a lot more difficult.
Thank you. Any questions? At the back there. Do we have a mic? Do we have a mic? Oh, there we go. At the back there. And was there another hand on the right-hand side?
At the moment, isn't it?
Oh, okay. Please, and just quickly introduce yourself and straight to the question.
I'm Chukudi Auna. I'm from a law firm in Lagos, Nigeria. My question is, how often is this reporting expected to be done, and is the fund managers expected to seek an approval for every single investment, bearing in mind that some of the investments could be, some decisions could be taken in very limited space of time, and or are they just meant to inform the investors of every single venture they seek to undertake?
Shall I start? I think we've got a combination between legal and fiction. I think, firstly, LPs should never take an investment decision. I think the LPs have to check whether a capital call or an investment is in line with the investment strategy. But an LP, in order to maintain the limited liability, and Angeli can correct me on that, can never say do or don't do a transaction. Each LP has the right to excuse themselves if there are certain provisions where you don't want to participate, but I think that shouldn't really affect the timing. On the reporting side, there are 3 major timelines. One is an annual reporting, where you get your audited financial, you get annual reports. There's quarterly reporting, and then there are certain ad hoc notices. And I think that's where often lapses happen, that not all ad hoc reporting items are being adhered to. And a lot of them are then on the social reputational side, that you immediately get informed if a litigation happens, if a death at one of the, or fatality happens at one of the project sites. And I think those are undertakings where the GP has to also manage the investees, because obviously it's investor information flowing through, and being clear and certain that the obligations you sign up towards your LPs also work on the lower level to get access to this information timelessly and immediate on those aspects.
So there's a real balancing act in the fund governance structures where you have to protect, as Anna said, the limited liability status of LPs, but you also want them to be able to hold the GPs accountable. So in order to achieve that balancing act, you need to, number one, ensure that your LPs are not taking investment decisions, but there are robust structures in place where they can understand what's going on in the actual fund. And therefore, you typically set up your advisory board, and then there's consultation rights, and there's regular meetings with your GP, and the reporting obligations that we've talked about are critical in that, because that allows the LP to understand what's going on and to see the red flags and alarm bells as they pop up. But no, completely agree, they should not be taking investment decisions themselves, because then they really are jeopardizing their own limited liability status.
Helene, do you have a comment? No? No comment. All right, guys, we're coming into land. Could I ask each of the panelists, could you leave us with one final thought that kind of encapsulates your contribution to our discussion on investor relations, development, and reporting? James, could we start with you?
Yeah, I think that material balanced reporting on an ESG basis will help GPs in a number of areas. It'll build that trust and credibility with the LP market. It'll give them a deeper understanding in their investments, and it'll communicate their values in a way that is meaningfully, correlated to their financial return. So I think the next couple of years is going to be a very interesting evolution in non-financial disclosure from African private equity, and I think it's going to be a very exciting space.
Excellent, thank you. Anna?
Thank you, James. I think for me, the main aspect circles around the relation aspect, and to say, look, legally it's a partnership, but I think factually it should also be a partnership, and it's a triangle between managing your team and resources, managing your investees and your investors in order to disclose information and in order to build the trust you want to have in order to not only attract capital once, but to maintain this relationship and go into fund two. And I think that's one big aspect to really look through it. I do think it's evolving. I think it's changed a lot. As Henry said, it's most probably a pendulum. We went from too little to too much, and we'll balance it at one stage again, hopefully. Although with the regulation it always gets more and never really reduces. But let's see. Hope lies last.
Excellent, thank you. Helene?
Just to add to that is basically the purpose of reporting is to keep you as a partner informed. And if you need to trust a partner, you need to get timeous and accurate and informative reporting. And that's really, I think, is what LPs are hoping for. And maybe just to touch on one thing that Anne said, which was around, the quarterly reporting is extremely important, but the thing that really builds trust is if there's been an incident which causes the need to report an ESG incident or whatever it is the fact that that is also done on a timeous basis and disclosed and, rather than possibly hearing it somewhere else in the market. Is one of the things which truly does build trust between LPs and GPs and make sure that it can be a long-term relationship.
Excellent, thank you. Anjali?
I think reporting shouldn't become a tick-boxing exercise. I think that, there has to be a common-sense approach to it as well. Otherwise, it can become overly burdensome, or it can just be ineffective because you're just putting, raw data without any analysis. So I think really thinking as a GP, what do you want your investors, what should investors know, what do they need to know in order to assess how the fund is doing? And letting them know ahead of time when things might be going wrong or, developments might be coming up, rather than letting them know after the event. I think this all goes to kind of ensuring that your relationship works nicely and effectively, and there's building trust and confidence.
Excellent. Please join me in thanking our panel.